Thank you for joining me for this presentation. My name is Brad Renard. I'm the CEO and Chief Investment Officer of MCTO Capital Management, and the objective of this presentation is to give you an overview of our firm. Summarizing our investment products, we offer alternative, long-short strategies that blend technical, fundamental, and quantitative analysis. About us, we're headquartered in San Diego, California. We've been managing clients' money since 2005. We specialize in developing long-short, hedged investment strategies that blend technical, fundamental, and quantitative analysis. We manage 4 strategies: Big Cap Alpha, Contrarian Fund, Sector Rotation, Small Cap Momentum. MCTO Leadership, my name is Brad Renard. I'm the CEO and Chief Investment Officer. I have 20 plus years of experience in stock and options trading. My personal interest is in developing blended strategies that leverage technical, fundamental, and quantitative analysis. I was in high tech for 20 years in Silicon Valley. I worked for myriad technology companies in engineering, marketing, and sales. My education is a BS in physics, BS in electrical engineering from Columbia University, and an MBA from the University of Chicago Booth School of Business. More on the team: Pranav Singh, he's a portfolio manager, and his primary area of interest is quantitative trading methodologies that blend technical and fundamental analysis. His education is in economics and finance and mathematics. Enrico Lombardi, he's a portfolio manager, and his primary area of interest is in the development and optimization of algorithmic trading strategies. And Bob Perry, he's director of software development. He's also an active options trader and market technician, and he's closely involved in the development and testing of our advanced investment and trading methodologies. What drives us to develop blended strategies? So the University of Chicago is home to 89 Nobel laureates, and the Booth School of Business has several professors classified as the founding fathers of investment theory. So while I was at Chicago, I had many lively debates with professors such as Eugene Fama, and he's a Nobel Prize winner, and Kenneth French about how to beat the market. The research at that time in the mid-90s showed that it was nearly impossible to beat the market through efficient market theory. However, Fama, French, and other academics during the 90s never could fully explain or model the concept of momentum. So that's where my interest started, and by augmenting macro and micro fundamental analysis with technical and quantitative analysis, and that component taps into momentum, that drives many of our strategies. Our strategies: we have Big Cap Alpha, so we buy stocks with strong technicals and fundamentals with a market cap of greater than 10 billion. Contrarian Fund, we buy stocks that have been out of favor for 6 to 12 months and sometimes longer, and that are starting to recover. Sector Rotation, we buy strong stocks within strong industry sectors. Small Cap Momentum, we buy stocks with strong momentum with a market cap of 250 million to 5 billion. And our strategies are long short. So for the bullish trades, we buy the underlying stock, and for the bearish trades, we buy put options. Our differentiation: we perform 4 levels of analysis, blending technical at the macro and micro level, fundamental, and factor-based quantitative. Our portfolios are long short, so we can make money in both directions, and that also helps with reducing volatility in the portfolios. We follow strict exit rules, so we're able to let most winners run, but our rules are fast enough to lock in gains and to protect capital. Our strategies are managed by traders that are nimble and fast moving. And I purposely use the word traders because traders are trained to follow exit rules decisively, and that is key to protecting capital in portfolios. More on our 4-level scanner. So step 1, macro analysis. Big picture, technical, breadth, fundamental, sentiment analysis, and this modulates our bullish and bearish exposure levels. 2, we do a technical scan to find high probability setups, and that's at the stock level. 3, also at the stock level, we do a fundamental screen looking for strong or weak companies. 4, we do a quantitative screen for probabilities of patterns following through. So we're looking for high probabilities. And then finally, we use technicals to trigger the entries and exits. Summarizing our portfolios, they're long short to help reduce volatility. We can make money in both directions. About 4 to 5% of capital is allocated to each trade, and we have strict exit rules. We're fast, but we are still able to let most winners run. But there's a delicate balance between letting the winners run and getting out fast enough to protect capital. We can usually keep losses below 5% per position, and that translates to about a 0.25% loss for the portfolio. And we have a hard stop at an 8% loss per position, which translates to about a 0.4% loss for the portfolio. Okay, the first step, as we showed in that last slide, was macro market analysis. Technical analysis at the macro level focuses on the charts of the major indices, such as the S&P 500, the NYSE Composite, the S&P 400, which are the mid caps, the RUT, which is the small caps, the Qs, which are 100 of the largest technology stocks, and the NASDAQ Composite, along with indicators of each of these charts. Some of the indicators we look at are support and resistance, trend lines, moving averages, big picture indicators such as on-balance volume and McClellan summation index. We monitor the daily and the weekly charts, especially the weekly charts for the big picture insight into the health of the market. And here's an example of kind of a big picture chart. To the right, we show the 1743 exponential moving average on the NASDAQ Composite Index. So here, this is the NASDAQ Composite, 2019 all the way back to 1999. This is a weekly chart, so each candlestick represents 1 week of trade. And then we have a 17 exponential moving average, these are weekly, and a 43 exponential moving average. And in general, with this type of chart, it shows us either we're in a long-term confirmed uptrend. For example, when the 17 crossed above the 43 EMA, that means we're in a long-term confirmed uptrend, and that was in mid-2009 after the crash in 2008. And then as long as the 17 stays above the 43, it tells us we're in a long-term confirmed uptrend. It's interesting how this chart got us out in January 2008, where the 17 crossed below the 43 EMA and gave us validation around March of 2008 to be out of the market. Back to where we are today, you can see that the 17 crossed above the 43 pretty much after the presidential election where Trump won, and you can see that the 17 has been above the 43 ever since. One thing I don't like about this chart is how steep this is right here. So this represents one chart of many that we look at the technical macro level. So here's some other things we look at the macro market level. We look at macroeconomic data, such as monthly employment report, initial unemployment claims, consumer credit, retail sales, ISM index, factory orders, inflation numbers, gross domestic product. And here's some of the charts over here that show these numbers. I'm just keeping them purposely small, but you can see that we're watching about 100 charts a week. We watch the 10-year Treasury and the yield curve, and a couple charts that represent that. We watch corporate earnings growth, and a chart that represents that. Corporate debt markets. We care about strength of the US dollar, Federal Reserve posture, market sentiment, and that includes breadth charts such as number of stocks above the 50-day SMA, advanced decline lines. We care about seasonality, sector rotation, overbought, oversold indicators, some charts that represent those market sentiment indicators, and outside influences such as China, Japan, Germany, France, plus geopolitical, and some charts that represent those. With regards to the macro analysis that we do weekly, this link will show a typical advisory that we do each week, and then we post it on the website. And going to that link, you'll see this. So this is what we create each week, usually through the weekend. We post it on the website by Monday. This is the analysis that we do at the highest level, so we can actually make predictions of where the market's going to go over the next 1 to 4 weeks. So we basically have analysis and summary at the top, and then detailed analysis digging into the charts, all the major indexes, S&P 500, the Dow, NASDAQ Composite, the Qs, mid caps, small caps. We look at macroeconomic data. For this particular report, the non-farm payroll report came in, so we showed the employment results. That's the first Friday of each month. We look at earnings and price data, earnings multiple, valuation, volatility, high yield bonds, currencies. We look at all the different countries, all the different sectors, financials, banks, industrials, consumer discretionary, staples, etc. These are all the different sectors. So all of this gives us insight into what the market is doing and predictions of where it's going to go. Here's breadth indicators for the S&P 500, NASDAQ Composite, advanced decline lines, cumulative advanced decline lines. So all this data helps us predict what the market's going to do for the next 1 to 4 weeks. And then the economic calendar. So there's the link right there. If you want to see other weekly market analysis reports, you can go to the website, the MCTOcapital.com website. Back to the four-level scanner. So step one, macro analysis. And that modulates our bullish and bearish exposure levels. And sometimes it'll actually push us to the sidelines. If we don't like what we see, we'll actually go to the sidelines for a week or two or three before we make any trades. Step two, we do a technical scan at the stock level now to find high probability setups. Technical analysis at the stock level focuses on charts of the stocks that we are trading, along with indicators. So we're looking at the candlesticks, support and resistance, trend lines, moving averages, indicators, such as the 535 oscillator and the CCI shown above. So here's an example of a typical chart. This one is on Google. We show a daily chart, candlesticks. We show a 50-day moving average, 200-day moving average, 13-day moving average. I show some resistance lines here at 1176. Support's actually down here around $1,000. Happen to show just two indicators, a 535 oscillator and a commodity channel index. So this is just an example of looking at the chart and doing a screen for specific bullish and bearish trade setups. So all MCTO portfolio managers are experienced chart technicians. So back to the four-level scanner. Step one was the macro analysis to help us modulate bullish and bearish exposure levels for the overall top-level portfolios. Step two, technical scan to find high probability setups. Step three, now we do a fundamental screen. We're looking for strong companies for the bullish trades and weak companies for the bearish trades. So at the stock level, we use specialized software to screen stocks to identify the companies with the following. We're looking for strong revenue growth, strong earnings growth, strong cash flow generation and growth, upper percentile for return on equity, among others. For the bearish trades, we screen for the opposite. We're looking for weak revenue growth, weak earnings growth, deteriorating cash flow generation, among others. So all portfolio managers at MCTO are experienced in performing fundamental stock analysis. Step one, macro. Step two was the technical scan to find high probability setups. Step three, fundamental screen, looking for strong or weak companies. Step four, a quantitative screen. Now we're looking for probabilities, high probabilities of a pattern following through. So factor-based quantitative analysis is the use of econometric statistical mathematics to provide predictions such as probability that a stock will break up or down through a particular level, probability that a stock will move a particular magnitude up or down once it breaks through that level. This requires several years of education in econometric mathematics and statistics, along with 2 or more years of experience in developing and optimizing the models so they can offer predictive significance. And here's a typical output of the model. So we run this model once a week, and it dumps out lots of numbers, and it analyzes about 3,500 stocks. So that actually provides a final screen when we're looking through stocks and making decisions of which ones to open, either bullish or bearish. Back to the four-level scanner. Step one, macro analysis at the highest levels. And that again helps us modulate bullish and bearish exposure levels. Step two, technical scan to find the high probability setups. Step three, fundamental screen, looking for the strong and weak companies. Step four, a quantitative screen, providing the probabilities. Step five, or the final step, is really the technicals to trigger entries and exits. And again, our portfolios are long short to help reduce volatility, and we can make money in both directions. We allocate 4 to 5% of the portfolio to each trade, and we have strict exit rules. We're fast, but we're still able to let most winners run. We can usually keep the losses below 5% per position. That translates to about a 0.25% loss for the entire portfolio, and hard stops at 8% loss per position, which translates to about a 0.4% loss for the entire portfolio. There's a summary of our strategies again. We have the big cap leaders, contrarian, sector rotation, small cap momentum. And again, the strategies are long short. So for the bullish trades, we buy the stock. For the bearish trades, we buy put options. And a few words about passive versus active investments. Many investors lost 40 to 60% of their money in the 2008-9 crash. Markets trend up gradually, but they drop quickly. When buying the market, quote unquote, a major index will historically return 7% to 9% annually. Indexes have all stocks, good and bad, so the returns are average. Passive investments in indexes have had abnormally high returns since the Trump presidential win in November 2016. So the reason I'm bringing this up is because the market's gone up for 2 years, and a lot of people are in passive investments of just buying ETFs, indexes, and letting them run. But it doesn't last forever. So back to this chart that I showed previously. This is the weekly chart of the NASDAQ composite. This has 2,500 stocks in it. So it's a good proxy for the overall market. 2019 going all the way back to 1999. Note how steep this is. This is a very steep uptrend where we're still in a confirmed long-term uptrend. The 17 EMA is above the 43 EMA on this weekly chart. Corporate earnings are growing, but plus 20% growth rates are not sustainable. And corporate earnings is what drives stocks. So corporate earnings did turn around. We actually had a earnings recession right here prior to the election, and companies were not generating earnings for about 5 consecutive quarters. And you can see that the market suffered. And then companies turned things around and started generating positive earnings just about the time that the election was over. And earnings have been strong. And the corporate tax cuts now are juicing earnings growth, and that's why we're seeing very strong earnings growth of plus 20 to plus 25% quarter over quarter. But that's not sustainable. And it's probably going to run out of steam by mid-2019. Markets will now be more volatile as the Fed is raising interest rates. The Fed will probably slow the economy down in 2019, and that's probably going to translate into a recession in 2020. So active trading-centric managers can navigate volatile markets. For our firm, we buy individual stocks with strong technicals, fundamentals, and high statistical probabilities to make above-average returns, and we also open bearish trades for hedges. We are nimble, our trades are open for a short period of time, and we exit positions quickly based on strict exit rules. That's it for my presentation. Thank you very much for your time. And you can send me an email if you have any questions. I'm Brad, and my email is brad@mctocapital.com, or you can use support@mctocapital.com, or please go to our website for more information, mctocapital.com, or a toll-free number, 877-248-7455. Thank you very much for your time.